Welcome to the Transparent FX Academy. I'm Nick, and I'm a top author and TradingView with over 190k reputation points. In this video, I will be speaking about USDJPY. Now, as usual, to keep the video as educational as possible, first I will be covering the technical aspect for this market, then we will be moving to the order flow by looking at the commitment of traders, so the COT data, so essentially what hedge funds and the big players in the market are doing. And by the end of the video, by using a combination of these two different types of analysis, we will try to understand where we have the highest probabilities for the next potential move here for this pair. So this is definitely a video you do not want to miss. If you're new to the channel, make sure to subscribe. This is the place to be for high quality, free trading education. Now, without further ado, let's jump straight onto the charts. Starting here from the monthly time frame, what we can see is that at the moment we have a market which is testing a quite strong historical monthly support and demand area and rejecting it to the upside. From here, in fact, all this previous push to the upside was created. Again, here, the market tested its zone and rejected it to the upside. At the moment, the market is testing and rejecting to the upside once again the exact same level. Now, the nearest level of resistance at this point would be this zone here. This was acting as previous support during the creation of this green candle. Then the market broke below the area, so that previous support was turned resistance here, and the market is currently facing this resistance and already started rejecting it to the upside. Sorry, to the downside. Now, let's drop down on the weekly time frame and see what we have. Now, from a weekly standpoint, at the moment, the market seems overextended to the upside and in need of a correction. Now, after an impulse, if you want to measure the correction, you have to take your Fibonacci from the low to the high of the impulse leg. And if we do that, we can see how the market has not yet retraced to the 0.32 of the Fibonacci taken on the impulse leg. Now, in a situation like this, there is definitely the possibility of seeing more bearish price action for the market to actually go and reach this level from a weekly standpoint. So there is definitely room for some bearish retracement here by approaching this market from a weekly standpoint. Dropping down on the daily time frame, what do we see? Now, here on the daily, the situation starts to be quite clear. We can notice how increasing this push to the downside, the market is also currently starting to create this M pattern. Now, in general, after the creation of an M pattern, what you would expect would be to first see a rejection to the upside for the completion of the M pattern at the neckline, and then the continuation to the downside. Now, from a daily standpoint, this would align perfectly with what we have seen on the monthly and weekly, because on the monthly, we can still expect more bullish price action because the market is still showing bullish momentum. However, we can also notice how now we are inside of that resistance level that we have previously identified, and the weekly is overextended to the upside, and so in need of a rejection lower. So if the market does create this M pattern, there is first a possibility of a rejection to the upside, kind of like a bull trap, and then the actual move to the downside could start after institutions have added their shorts on the retest of the neckline of the M pattern. Now, why do I say institutions add shorts on the retest of the neckline? Because already we can see that they have been adding some shorts. In fact, if we go and see what we have when it comes to the commitment of traders, so what the big players in the market are doing, and we look at the data precisely for the JPY, what we can see is that in the long run, institutions have indeed been moving to the bearish side for the JPY. We went, in fact, from having a positive net positioning of 66k net positions all the way down to having minus 64.9k net positions, therefore showing a clear decrease of net positioning and moving to the bearish side for this currency. However, every currency on the spot is traded against the USD. So if institutions are shorting the JPY, they're actually longing USDJPY in the long run. And that looks quite clear when we're looking at the monthly time frame, as we're seeing this massive uptrend. However, in the very short term, what we can also notice is that if we look at the changes in longs and shorts, we can see how already with the last report, 3,700 longs were added with the last report on the JPY USD, meaning the 3,700 shorts were added with the last report on USD JPY. So as institutions are already shorting USDJPY, if we will see this M pattern and then correction at the neckline, here there is a possibility of seeing more shorts being added and then to see a potential push lower. However, let's approach the situation one at a time. First, what the market would need to do in this kind of situation is go and complete the M pattern after having created it. So if the market here will create this M pattern, we are still in a situation where institutions have moved aggressively to the bearish side for the JPY, so to the bullish side for USDJPY. So there is definitely the possibility of seeing this potential rejection to the upside and completion at the neckline. So if the market will create this M pattern, what would I expect? Well, as usual, trading is reactive and not predictive. The monthly, weekly, and daily timeframes combined with the COT data, those are the best timeframes when it comes to the directional aspect of the market. However, when it comes to identifying early shifts in the trend of a market, the best timeframes for that are the intraday timeframes, so 4 hour and lower. Therefore, what I would expect is that if this market would shift from an intraday bearish to bullish market, at that point, I wouldn't be surprised to see a potential rejection to the upside for the market to go and complete this M pattern, the neckline. That definitely wouldn't surprise me. Now, if you want to learn more, I really suggest that you go and check out the transparentfxtrading.com website, which you find linked in description. Here, you have the possibility to gain access to the most complete mentorship program ever. You have the possibility to gain access to all my courses, which will guide you from the basics to the most advanced topics like automated algorithmic trading using the MQL4 language. Then you will also gain access to the trading station software with a Telegram notifications integration directly on your panel. You will also have the possibility to have one-on-one mentoring directly with me, as well as having access to the COT data software, which is the one that you see me use very often in my videos. And if you continue to scroll down on the website, you will see that you have the possibility to join and gain automatically access with the email and password that you will create during the registration process. So I really suggest that you go and check it out as soon as possible. The link is in the description, and I will see you on your student dashboard. If you enjoyed the video, make sure to drop a like. Also, let me know in the comments below any pairs or topics that you would like me to cover in the next videos, and I will see you in my next breakdown.